Hey traders, Jason here from Leavitt Brothers. Happy Tuesday. I feel like I should do updates on my State of the Market video series a little bit more often right now because things are changing kind of quickly. Okay, it doesn't mean they have to change right now, but they seem to be changing a lot more quickly week to week. Unlike times where we have a steady uptrend and it's basically just the same old. They go from good to bad and back to neutral, and it's good to keep tabs on things. So in last week's video, I ended with saying that the breadth indicators needed to improve, otherwise there'd be another leg down. So in this video, I'm going to do an update. Okay, what is the state of the market right now? I'm going to go over some of the indexes, and then I'm going to go over a couple of the breadth indicators just to kind of check out what the state of things is right now. All right, so here is the S&P 500. I'm going to point out a couple things, just random thoughts as I just look at this chart. So the one I see, we have a new high here, but then not a whole lot of follow through. And then we have another new high, but again, not a whole lot of follow through. Okay, so that's one thing. We're making new highs overall, but not a whole lot of energy and enthusiasm when we do make new highs. Another thing that I notice is the 21. This is a daily chart, so the 21, which is the orange line here, has been a pretty good support and resistance level. It's there, resistance there, support there, resistance there, and price action right now is sitting right there. Okay, so it's kind of an important level. Okay, I guess you can say like we're in a downtrend maybe because we're below that moving average and we've rallied up to the moving average, so we'll see what happens. If we can get above the moving average, come down and maybe test it and continue on, then maybe we have a resumption of the uptrend. Okay, so another thing that my eye picks out when I take a quick glance at the chart. Otherwise, the other thing I see is just the general action. We have a move up, a move down with a consolidation, a pop to the low, then a move up, a move down, another consolidation. There's nothing wrong with this action. I mean, the market doesn't have to do everything at all times. It doesn't have to trend like the way you want it to trend. Sometimes it moves predictably, sometimes it doesn't. It moved up, it moved down, then it moved up, and now it's moving down in a volatile fashion. So there's nothing really jumps out as being overly bad or overly good. To me, it looks like business as usual. Again, noted that the inability of the market to really follow through after making new highs, but otherwise it looks like business as usual. Okay, nothing really stands out. Okay, so overall I see a market that's mostly neutral right now. I guess I would lean to the upside. We're above the 200, we're below the 50. But price is unchanged going back to April. It's unchanged going back to last September, so we're almost at basically 52 weeks ago we're at the same level. So overall, lean up, but kind of neutral, definitely lacks directional momentum. All right, let's go to the next one. So here is the Russell 2000. So we have high here, low here, and most of the price action is taking place within that box. So again, kind of like the S&P, this is obviously in worse shape because there's no uptrend, no overall uptrend in place. But you have a high and a low, and you have the price consolidating for 6-7 months, right in the middle of the price action, right in the middle of the range. You have the 200 and the 50 are flat. So this isn't bullish, it's not bearish, it's just neutral. Maybe you can lean down a little bit because we're below the moving averages and we need to get back up to the top half of the range. But overall, this is just a neutral pattern within the range going back 12 months. Okay, there's nothing bullish about it. There's nothing really bearish about it. It's just a resting period. Here is the S&P mid caps. Okay, so similar to the small caps, you have high there, low here. Most of the price action is taking place like within a range. So similar to the small caps, you have just a range within a range. This range is taking place in like the top half of the range, so it's doing a little bit better. But again, moving averages are flat. Range has persisted for 6-7 months. It's more neutral. There's no directional momentum or energy or anything. It's just the market is just flat, going up and down. And that's just the way it is. So it's a stockbreaker's market. Individually, there are a lot of stocks that are moving, but as far as the indexes go, they're not doing much. And to be honest with you, there's nothing wrong with this. I mean, if the market wants to move sideways in a range for another 6 months, that's fine. We'll find the leadership stocks and we'll just trade them over and over, and we'll make our money. Okay, so these charts are telling us don't be overly bullish, don't be overly bearish, because the reality is the market's pretty neutral right now. Okay, let's look at some indicators. All right, here's the S&P 500 versus the 10-day moving average of the AD line. Okay, those of you who are familiar with my work, you've heard me say this many times. When the market does well, the 10-day, the AD line oscillates up and down within a range, mostly above zero, but there are dips below. And so I want to point out a few things here. So here we got a divergence. Okay, a divergence, and then we got lots of prints, down here. Okay, and you can see that this was higher high. Okay, so there were recoveries here, but the recoveries didn't last long. It went above, but then it went back below, went above, and then went back below. Okay, if you compare this to, let's say, May, where we had a divergence, then we had lots of prints below, but when we had a recovery, prices were able to hold up. Okay, and that's, whoops, don't want that one. Prices were able to hold up, and that's the difference between this dip in May and this dip back in October, November, December, is that this indicator got below zero. It stayed there for a longer period of time. When it recovered, it immediately lost it, whereas in May, we got the divergence down near zero. Eventually, the indicator went below zero, pullback happened, but the recovery took place, and then we got prints above zero, and they stayed there. We didn't get any dips back below. So what I'm looking for right now, and really the same thing happened. We had a divergence here. Okay, now we got prints below zero. Prints below zero, and now we have a recovery. Okay, so if we get continued prints up here, the market will be in good shape. If this loses it and comes back down here, then the market's going to do this. Okay, so the question is, we have, move up and then a move down, and the question is today more similar to May, or is it more similar to last, October, November, December? And as of right now, I'm open to a move up. Okay, let the indicator guide us. Let's not guess. Let's not predict. If it can hold above zero, we're in good shape. If it drops below, then we're probably in trouble again. All right, here's new highs. S&P 500 up top, NYSE new highs down below. So when the market's doing well, you get steady prints up here, which has been exactly the case. We've had steady prints above. Okay, you'll notice that in October, November, December, we started getting prints down here. Okay, and that was the difference between, if you look at the May pullback, we got a little dip here, but for the most part, but it immediately recovered, and for the most part, we got prints above into the box. Down here, we got a divergence, with the new highs going down, market going up, but we got prints at a really low level, and then when they recovered, they immediately lost it. Okay, so with new highs right here continuing to print at a pretty good level, the current situation looks a heck of a lot more like May than it did last September, October. So this is pretty bullish. Even though the market is moving sideways, this is pretty bullish. This is the S&P 500 versus the NYSE high-low differential. So it's highs minus lows. Again, when the market's healthy, you get steady prints like here, okay, which is what we've gotten. But you'll notice that divergence here, and then prints down here at zero. Even though the market's at its highs, we're getting prints near zero. All right. So, and then obviously we got like a lot of prints down below zero, and we got like really deep penetration here. Okay, so if you compare it to, let's say, May, where we have steady prints above, okay, a little bit, not really a divergence, but this thing weakened as the market fell, but we didn't get any low prints. Okay, we didn't get anything down here, and when it recovered and stayed above zero. Okay, so that's the difference between this pullback became much worse, and this pullback didn't get much worse. So right now we got a dip below, some up and down movement, and now a recovery. Okay, so right now the current situation looks worse than May, but certainly not as bad as October, November. Okay, so again, it like leans bullish, even though the market is moving sideways. It leans bullish, and it tells us not to get too bearish, even though the headlines and everything out there are pretty bad. Okay, 2 more charts. What we have here is S&P 500 up top. Middle pane is percentage of S&P stocks above their 20-day moving average, and down below is percentage of S&P stocks above their 50-day moving average. Okay, when the market does well, you get steady prints, like here above 50%. When the market dips, you get dips below. It's normal. Market moves up, market moves down. Okay, so if I compare the current situation to May and to late last year, it looks, if I point some things out here, we had moved down, much lower prints, and an inability to recover. When it did recover, they lost it right away. Okay, and then we recovered and we lost it right away. So when the market is trending out, you get these big volatile moves. Okay, because we know that because the biggest up moves occur in downtrends. So you get like an hysterical move up that lasts a day or two. Stocks can get above their 20-day moving average, so this indicator moves up, but they can't hold it. It moves back down. Okay, compare that to May, where you got to move down, based a little bit, no big deal. When it recovered, then it maintained prints above 50%. So what I'm looking for going forward here is if this can get above, then it's going to be decision time. Okay, if it could, do something like this, the market will be in good shape. If it does this, then we might get a repeat of last November, December. Okay, let the indicator guide you. Don't guess. Okay, right now it's looking at least structurally more like May. If we can get improvement here, then it's going to be either hold the level or give it back, and that'll tell us what's going to happen next. Last chart, AAII bulls minus bears. Just want to point out sentiment. Sentiment has gotten pretty negative with the Fed and trade wars and all this other garbage going on. Politics is just nonstop in the headlines. But that's actually a pretty good place to start a rally from. Okay, going back, if we had low prints here and the market rallied, low prints last July, same thing. That was a continuation of the rally. Last December, we got a whole cluster of really low prints, and that was the bottom. May, low prints, resumption of the trend. And then just recently, we have had 3 straight weeks. This is the weekly chart. We had 3 straight weeks of bears outnumbering bulls. And as negative as things are in the press, that's actually a good foundation for starting the next leg up. Okay, doesn't have to happen, but when things seem really bad, that seems to be a foundation for better things to come. All right, so the indexes are flat and completely lack any type of directional momentum. Breadth has improved, but now it has to hold up. Okay, if the indicators shown here break down, the market will start looking more like December. But if they can hold their current levels, improve some, the market will look more like May, and we're probably going to rally back to the highs. Okay, just remember, for all that is bad that's going on in the world, for as bad as the news and headlines have been, the market is simply trading in a range. Okay, it has been able to absorb a lot of negativity without being too damaged. Okay, so and because of this, you gotta respect its resiliency. Okay, if it really was that bad, then these negative headlines would probably cause a lot more selling pressure. The fact that it's been able to hold up fairly well, okay, it's not doing fantastic, but it's not doing horrible. The fact that it's been able to hold up fairly well, again, you should respect its resiliency. Okay, thanks for listening, and I will see you next time.